Computershare, the world's biggest share registry, is pushing ahead with expansion plans, even though first-half earnings are expected to fall 15%. Shareholders were warned of tough times ahead at today's annual general meeting in Melbourne. Emily Stewart reports.
The board of Computershare says this is the most difficult time the company has experienced since it started in 1978.
Basically, for a company that's been a growth story for a long, long time, the last few years have been flat. We have actually achieved a lot of things, and there's an old saying about running flat out to stand still, and I think that's to an extent what we've been doing over the last 3 or 4 years.
Computershare provides an integrated investor service as well as financial and communication systems. Chief Executive Stuart Crosby says during the past financial crises, Computershare has relied on revenue from companies recapitalising, but this time round that hasn't happened.
Things like bankruptcy administration, which you would expect to hold you up in bad times, bankruptcy levels in the US are at cyclical lows because of the easing of credit that the US government has engaged in to try and support the economy through these difficult times.
The company's traditional revenue stream, transactional activity, has fallen by 50% in the past 3 years, leaving a $600 million hole in revenue. Computershare says it's filled that gap by moving into business services such as corporate trust and mutual record keeping, as well as lowering staff numbers. Despite the difficulties, Computershare has been on the lookout for acquisitions, taking over 4 companies in this calendar year alone. This week, the $550 million takeover at the shareowner services arm of the Bank of New York Mellon received clearance from the US competition regulator. The deal is set to be finalised in the new year.
We've had a team on the ground there ready to go that is now finally able to engage with the clients and the employees of the business we're acquiring, which you just can't do while you're seeking antitrust approval.
Computershare's sort of been founded on challenges. The best thing about it is it gives everyone in the company, the staff, saying, Computershare, we're back. It's something that I think is great for Computershare.
Computershare expects to gain $70 million in synergies from the takeover, but this will take 3 years to be realised. And for now, the company is predicting further tough times ahead.
The truth is the first half has been really, really tough. We're expecting our first half results to be off about 15%. On what they were last year.
It's a sentiment investors took note of, with Computershare down 1%.